Bismillahirrahmanirrahim. I am very happy to upload the 100th video, and I am thankful to all the subscribers and viewers of my channel in making this possible. And we are adding a new accounting course, Cost Accounting. In the first video on cost accounting, we will explain the concept of flexible budgets, direct cost variances, and management control. In this video, we will show how business organizations can increase profits by controlling cost. We will see how a manager uses budgeting and variance analysis tools for controlling cost. Then we'll talk about the concept of static budgets and static budget variances and solve an exercise. Next, we will examine the concept of flexible budget variances and explain how to develop one with the help of an illustration. And finally, we will solve exercises on flexible budget, static budget variance analysis, and flexible budget variance analysis. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who want to refresh their learning on static and flexible budgets and variances. A special word of thanks to my colleague Mr. Muhammad Zahid Ramli, who helped me in clarifying the doubts while solving an illustration. So, let us talk about how a manager uses budgeting and variance analysis tools for controlling cost. A business organization can maximize profits either by increasing revenues or reducing cost. In this video, we will discuss how a business organization can increase profits by reducing cost. We will see how a manager uses budgeting and variance analysis tools for controlling cost. Interestingly, controlling cost leads to reducing cost. That means reducing wastages, inefficiencies, thereby making the organization more environmental friendly, an important organizational goal in the modern business. Let us talk about a real business example. Shipping goods is both costly and one of the biggest source of carbon emissions globally. Walmart found a way to deliver more goods to its stores while driving fewer miles. They were not only able to deliver more goods, but they also ensured to reduce greenhouse gas emissions and the company's standards budgeted cost of transporting products. In 2005, Walmart planned to double the efficiency of its fleet of 6,000 trucks by 2015. To achieve this, in 10 years' time, the company identified and eliminated unproductive driving routes. They collaborated with tractor and trailer manufacturers on new green technologies for its trucks, such as hybrid power trains and carbon fiber trailers. The company was able to achieve its efficiency goal 6 months ahead of the schedule. The company delivers 1 billion more cases of goods than it did in 2005 and drives 460 million fewer miles that has reduced the company's carbon dioxide emissions by 650,000 metric tons annually. This also helped Walmart to significantly reduce its standard transportation cost. The company saves more than $1 billion annually. Budgets help managers in planning effectively and efficiently. Let us see how flexible budgets are used to compute variances that assist managers in controlling the operations. We will also learn how variance analysis help managers to evaluate performance and how after decisions are implemented. Let us now talk about static budgets and variances. A variance is the difference between actual results and expected performance, all called budgeted performance. Variance analysis is the most popular decision making costing tool used by organizations of all sizes. Variances bring together the planning and control functions and facilitate management by exception. We will never consider a manager to be efficient and effective if the actual costs are much higher than budgeted. A positive variance occurs when the actual cost lower than planned cost, and this may be because of better operators training or changes in manufacturing methods. Variances are also used for evaluating performance and to motivate managers. For example, a manager gets incentives that are linked to achieve a budgeted amount of operating cost. Sometimes variances suggest that the company should consider a change in strategy. If the defect rates for a new product is very large, the managers may investigate and modify the product design or withdraw the product from the market. So, variances help managers in making more informed predictions, thereby improving the quality of the decision. Next, let us talk about static budget and static budget variances. The static budget or master budget is based on the level of output planned at the start of the budget period. The master budget is called a static budget because the budget for the period is developed around a single static planned output level. The variance analysis details are provided at different levels. Level 1 reports least detail and level 2 reports more information and so on. So let us look into an example. Web company manufactures and sells jackets. The jackets require tailoring and many other hand operations. Web sell exclusively to distributors who in turn sell to independent clothing stores and retail chains. These are the assumptions. Web's only costs are in the manufacturing function. There are no costs of marketing and distribution. Uh, all costs manufactured are sold in the same period. There are no beginning or ending direct material work in process or finished goods inventory. These are the budgeted variable cost per unit. We have direct material cost 60, we have budgeted direct manufacturing labor 16, 12, and the total budgeted variable cost is 88. So you can see that the number of units manufactured is the cost driver for direct material, direct manufacturing labor, and variable manufacturing cost, overhead cost. The budgeted and actual data are also given to us. We have the actual revenue, we have the direct material cost, we have the actual jacket produced, and we have the actual price cost per unit, and we have the budgeted price cost as such. Then we have the budgeted fixed cost for production between 0 to 12,000 jackets. So you can see that this is the cost driver for 0 to 12,000 jackets, that is 276,000, and we are required to prepare a static budget. Now the budgeted production was 12,000 while the actual production is 10,000. You can see that the budgeted selling price is 120 while you can see that the actual price uh, is total revenue, actual total revenue divided by the actual production of 10,000, that is 125. So in the first column of this exhibit, we are going to present the static budget, and let us see how we are going to do it. So we have the static budget in the first column, then we have the actual results, that is in the second column. This will display the actual results, and then we will talk about the potential reasons of these differences. Now the static budget variance is in the third column, and here we are going to record the difference between the actual result and the corresponding budgeted amount in the static budget. Now a variance can be favorable, will be denoted by F. It has a favorable effect if revenue will increase operating income. So if actual revenue is more than the budgeted amount for revenue items, the variance is favorable. For cost items, favorable means actual costs are less than budgeted. A unfavorable variance has the opposite effect. So if actual revenue is less than the budgeted amount for revenues items, the variance is unfavorable. So let us see how we are going to prepare the static budget. First of all, we have the units sold, and let me clean up this place. So we have the units sold, and the units sold is 12,000. The revenue will be at the budgeted selling price of 120 each. So 120 times the 12,000, and this will be equal to 1,440,000. Then we are going to record the variable cost, and the variable cost is going to be once again 12,000, the units sold, times the direct material cost, that is 60. So 60 times 120 is 720,000. Then we have direct manufacturing labor, and direct manufacturing labor cost is 16, the budgeted, and the budgeted units are 12,000. So 16 times 12,000 is going to be 192,000. Then we have manufacturing overhead, 12 times 12,000, that is 144,000. So the total variable cost is 1,056,000, and the contribution will be sales minus the total variable cost, that is 384,000. The fixed cost is 276,000. So the operating income is contribution margin minus the fixed cost, that is 108,000. Next, we are going to prepare the actual results, and for this we have the actual units produced is 10,000, and the revenue is given to us as 1,250,000, the actual revenue. The actual direct material is 621,600, We have direct manufacturing labor of 198,000. We have variable manufacturing overhead of 130,500, and the total variable cost will be 950,100. And the contribution margin will be the total revenue minus the total variable cost, and this will be equal to 299,900. The fixed cost is given as 285,000. So the operating income is contribution margin minus fixed cost, that is 14,900. Now we can look into the static budget variance, that will be the actual result minus the static budget. You can see that our units sold is 2,000 less, so this becomes unfavorable. Then we have revenues, and actual revenue is less by 190,000, so this is unfavorable. Again, the direct material cost is less by 98,400, so this is favorable. We have unfavorable direct manufacturing cost of 6,000. Then we have the now the variable manufacturing overhead. Again, you can see that the actual variable manufacturing overhead is less than the static budget, so once again this is going to be favorable. 13,500, this is favorable. And then the total variable cost, again you can see that the actual is less than the static budget, so once again it is favorable, and this is favorable by 105,900. For the fixed costs, for the contribution margin, it is unfavorable by 84,100, and the fixed cost is unfavorable. Again, you can see we have actual more than the budgeted, so that is unfavorable by 9,000. And if you look at the overall operating income, this is going to be 93,100 unfavorable, because our actual profit is less than the static budget. So in the end, you can see that we have the unfavorable static budget for operating income, and that is 93,100, and this is calculated by subtracting the static budget operating income of 108,000 from actual operating income of 14,900. The analysis in this exhibit provides manager with additional information on the static budget variance for operating income of 93,100. A more detailed breakdown indicates how the line items that comprise operating income, revenues, individual variable cost, and fixed cost add up to the static budget variance of 93,100. So if the manager wants to know how much of the static budget variance is due to inaccurate forecasting, you can see that they expected to produce 12,000 jackets, but they have actually produced only 10,000 jackets. So managers must create, therefore they must create a flexible budget that enables a more in-depth understanding of deviations from the static budget. So let us now talk about a bit about what is a flexible budget, and let us see how it helps in controlling cost. Now, before we talk about the flexible budget, I have put this calculation in a table over here to make you understand things in case you find it difficult to read my handwriting. So a flexible budget calculates budgeted revenues and budgeted cost based on the actual output in the budget period. The flexible budget is prepared at the end of the period after managers know the actual output of 10,000 jackets. The flexible budget is the hypothetical budget that the company would have prepared at the start of the budget period if it had correctly forecasted that the actual output would be 10,000 jackets. So we are continuing with the same example, but we have you made the static budget in the previous slide over here, if you can remember, and we are continuing with this information with some additions as well. You can see that these are the budgeted figures, and these budgeted figures are coming from the question itself, from the previous slide, this slide. So we have over here, and now the company has planned to produce 12,000 units, but you can see that actually they have produced 10,000 units or jacket as such. So when we are going to prepare the flexible budget, we are going to calculate the variable cost on the basis of the actual production. So 10,000 times 60 will give us 600,000. 10,000 times 16 will give 160. 10,000 times 12 will give 120, and the total is 10,000 times 18 times 88, that is 880. If you can remember, the flexible fixed budget was 276. So that is what we have over here, fixed budget as 206, and the difference now is going to give us, and then we have the flexible budget total cost as 1,156,000. Now this is what we have already prepared at level 1 analysis. So I have simply copied and pasted from here, and we are going to go for the level 2 analysis. But before we go for the level 2 analysis, I would like to show you some interesting observations. Now the budgeted selling price was 120 in the static budget, and the budgeted unit variable cost is the same as it was in the static budget, 88. We are using the same figures. The budgeted total fixed cost was 276 and the static budget, and we have the same over here as well. However, since 10,000 jackets were produced and they fall within the range of 0 to 12,000 units, that is what they have said over here, budgeted fixed cost for production between 0 to 12,000 jackets. So 10,000 is within this range, so the budgeted fixed cost will still be considered as 276,000. The only difference between the static budget and the flexible budget is that in the static budget we prepared the planned output of 12,000 jackets, whereas in the flexible budget, that is what we are going to do now, will be based upon the actual production of jackets, that is 10,000. So that's why you can see that all these values have been multiplied by 10 in the example in this table. Okay. So you can see that under the static budget, the static budget is flexed, or it is adjusted from 12,000 jackets to 10,000 units, 10,000 jackets, and I have simply put the values for the static budget and the actual budget because it will be with the same steps. And now we are going to prepare the flexible budget. Don't forget that we are going to use the actual units being produced, that is 10,000, and we are going to use the budgeted figures. Now the revenue, if you can remember, the budgeted cost per unit was 100 and it was why the budgeted selling price is 120, but we are going to use the actual production. So 120 times 10,000 is 1,200,000. Then we have the direct material, and that is 600,000. We have the direct manufacturing labor of 160,000. We have the variable manufacturing overhead of 120,000, and when you add up these variable costs, this will be equal to 880,000. Contribution margin is sales minus total variable cost, so this will be 320,000. And the fixed cost is 276. We already know this. So the operating income is contribution margin minus fixed cost, that is 44,000. Next, we prepare the flexible budget, and for the flexible budget, we are going to 1 minute. For the flexible budget, we are going to have the actual results minus the flexible budget, and you can see that 10,000, so there is no difference as far as units sold are concerned. The revenue has increased by 50,000, so this is favorable. Direct material is 21,600, unfavorable. Direct manufacturing labor is 38,000, unfavorable. Then we have variable manufacturing overhead. Again, you can see it is unfavorable by 10,500. Then we have the total variable cost, and the total variable cost is 70,100, and this is also unfavorable. Contribution margin is also unfavorable by 20,100. Fixed cost is, again you can see, is more by for the actual results, so this is unfavorable again by 9,000. And in the end, you can see that the operating income is unfavorable by 29,100. Next, we prepare the sales volume variance, and as you can see that the sales volume variance is the flexible budget minus the static budget. And again, now you can see that the unit sold is unfavorable by 2,000. We sell 2,000 units less. Revenue is less by 240,000. This is unfavorable. The direct material is favorable by 120,000. It is less. Direct manufacturing labor is favorable by 32,000. The variable manufacturing overhead is favorable by 24,000. The total variable cost is favorable by thus 176,000. The contribution margin is unfavorable by 64,000, and there is no change as far as the fixed cost is concerned. You can see 276 and 276, and the operating income is unfavorable by 64,000. So that's how we prepare the flexible budget, and we take the actual production and the budgeted values. So next, now we are going to solve some exercises on static and flexible budgets. Now, we have the first one over here. And this is simply I have put it in a table just in case if there may be some marginal error in while I am writing, or you find difficulty in reading these numbers. I have put this in this table as well. Okay. So, a Italian manufacturer of leather belts budgeted price for direct material, direct manufacturing labor, and direct marketing are 41, 5, and 11. The president is pleased with the following performance. You can see all are favorable. Actual output was 9,000 units. Now you can see that we have the direct material of 410,000 and each unit is for 41. So the total budgeted units are going to be 410 divided by 41. That will give us 10,000. Okay, now direct material is 410,000. The static budget, direct manufacturing labor is 50,000 and direct marketing labor is 110,000. So the total direct cost is 570,000. So what you can see that when this manager has got this table, that they have not made any adjustments for changes in output levels. You can see there is a change with the output unit was 10,000 units, but they have actually produced 9,000 units. So that's why we are going to go for level 2 analysis, and that will present a flexible budget variance and the sales volume variance of each direct cost category. And then we are going to make a comparison of level 1 and level 2. So the actual results are, in our case, is going to be for the actual units produced, and that is 9,000. And the actual cost is 373,500. Then we have 48,600, and then we have 103,500. So the total comes out to be 525,600. Next, we are going to prepare the flexible budget, and for flexible budget we will take the actual production, but we are going to take the budgeted prices. So 900 times 41 is 369,000. 900 times 5 is 45,000, and 900 times 11 is 99,000. So the total direct cost will be 513,000. Let us look into the variance. First of all, the flexible budget variance, that is actual results minus the flexible budget. So obviously 9,000 minus 10,000 is 0, but then the direct material is unfavorable by 4,500. Direct manufacturing labor is unfavorable by 3,600. And direct marketing labor is unfavorable by 4,500. So the total direct cost is unfavorable by 12,600. Then we look into the sales volume variance, and for the sales volume variance we are going to have the flexible budget minus the static budget, and you can see that it is unfavorable by 1,000. Unfavorable. Direct material is favorable by 41,000, it is less. Direct manufacturing labor is favorable again by 5,000. Then direct marketing labor is favorable by 11,000, and total direct cost is favorable by 57,000. Now, so this is how we make the analysis, but when you look into the level 1 analysis that is in the question, you can see that it shows a favorable, a total of these three is going to be 44,400. However, the level 2 analysis reveal that the favorable variance is due to the reduction in output of 1,000 units from the budgeted 10,000. You see, we have actually produced 9,000 and not 10,000. So the reduction in the output is taken into account in flexible budget, as you can see over here, and the flexible budget variance shows each direct cost category to have a unfavorable variance as such. And I can explain you more. Over here we have budgeted for 10,000 units. Actually we have produced 9,000 units. You can see the budgeted was 10,000 and the actual was 9,000, and the budgeted prices was 41, 5 and 11. But when we look into the actual, you can see that the actual was 373. 373 divided by 9,000 will give us 41.5. Then 48,600 divided by 9,000 will give us 5.4. And 103,500 divided by 9,000 will give us 11.5. So we have prepared a revised performance report, and you can see that not everything is as rosy as it was depicted in the question. Next, let us solve one more exercise, and this will be the last exercise in this video, and we will look into how we are going to move. Now, again, before we move ahead, I have put this in a table in case you find difficulty to read my handwriting, or I have made some minor mistake while writing the numbers. So let us look into the last exercise. We have flexible budget preparation, and we have Dartford Enterprise. They have just one product line of scientific calculators. The current standard cost of 1 unit of the product is as follows. We have selling price, direct labor, direct material. During the last month, due to an unexpected fall in demand for the product, only 15,000 units were made. So you can see that the budgeted was 20,000, but they have actually made 15,000, and these are the actual results for the month: sales, direct labor, material, etc. And they have asked us to prepare a static budget based variance analysis at last month's performance. So we are going to look into how we are going to make these calculations. Now the output, the static output was the static output was 20,000. Then we have the revenue, and the revenue will be 20,000 times selling price 10.5, that is 210,000. Direct labor, you can see we have 2.3 times 20,000, and this will be equal to 46,000. Then we have direct material, and direct material is 1.5 times 20,000, and that makes 30,000. Now the contribution margin will be the total revenue minus direct labor and minus direct material, and that is equal to 134,000. The fixed cost is 20,000 times 3.3. That will give us 66,000. So the operating income is contribution minus fixed cost, that is 68,000. Next, we move on to calculate the actual budget. And you can see that actually they have produced 15,000 units. So we have the output of 15,000. Then there is revenue of 153,900. We have direct labor of 3540. Then we have direct material 23,360. And so the contribution margin will be revenue minus direct labor and direct material, that is 95,500. From this we are going to subtract the fixed cost, and the fixed cost is 67,350. So the operating income is contribution margin minus fixed cost, that is 28,150. And now we can prepare the static budget variance, and that will be static budget minus actual budget. So that is equal to, that will give us unfavorable 5,000. Then we have unfavorable revenue of 56,100. Then we have now the favorable, because our cost is less than the static budget by 10,960. So this is favorable. Again we have 6,640 favorable. The contribution margin is unfortunately unfavorable, 38,500. Then we have the unfavorable fixed cost of 1,350. And then we have the operating income unfavorable as 39,850. Okay. So next, so this is the first part, as we were required to prepare a static budget, and now we are going to prepare a flexible budget variance analysis of last month, and we will be simply carrying this information also on the next slide. And before I do that, I have put this table, this calculation in this table, in case you find difficult to read my handwriting, or if I have made any mistake while writing the answer. Okay. So next we are going to prepare the flexible budget, and for the flexible budget, again we have the output, now these figures are simply picked from the calculations we have done in the part 1. We can see operating income, static budget and actual budget. So we have the static budget and the actual budget, and static budget and the actual budget, and we prepare the flexible budget. And don't forget that when we prepare the flexible budget, we use the actual output but the budgeted prices. Okay, so we have 15,000, and then we have the flexible budget is 15,000, and then we have the revenue, that will be 15,000 times 10.5, that is 157,500. Then we have direct labor, that is 15,000 times 2.3, that is 34,500. Then we have direct material, and this is 1.5 times 15,000, that is 22,500. Now we can calculate the contribution margin, that is revenue minus direct labor minus direct material, that is 100,500. From this we are going to subtract the fixed cost, and fixed cost will remain fixed because it is within the stipulated range of 60, so that will be 66,000. So contribution margin minus operating income will give us, minus fixed cost will give us the operating income of 34,500. Next we prepare the we prepare the flexible budget, and the flexible budget is actual budget minus the flexible budget. So here it will be 0 definitely, but then the revenue is unfavorable by 3600. Direct labor is unfavorable by 540. Direct material is unfavorable by 860. Contribution margin is unfavorable by 5000. The fixed cost is unfavorable. Fixed cost is how much is this? 23 20. So this is going to be unfavorable by how much? 1350. And then the operating income is again unfavorable by 6350. Okay, next we go for the sales volume variance, and the sales volume variance is the flexible budget minus the static budget. You can see the out units are unfavorable by 5000. Then we have the revenue unfavorable by 52,500. Then we have direct labor favorable by 11,500. We have favorable direct material also 7,500. We have contribution margin unfavorable 33,500. There is no difference for fixed cost. You can see 66 and 66. And operating income is unfavorable by 33,500. Okay. Okay. So that is the preparation of the flexible budget based variance analysis. And then we go to part 3. Which department managers contribute the most to the success or failure of the budget during the month? So obviously it is the sales department that is responsible for the poor performance of the business, as the sales department is responsible for the revenues of the business. You can see that the actual sales revenue was 52,500 less than the budgeted sales revenue, while the actual fixed cost was 1,304 more than the budgeted fixed cost. So both together this led to the total fall of 6,350 in the operating income. You can see that the company recorded favorable performance in the variable cost. You can see we have direct labor, direct material, both of them were variable. So this completes the video, and I hope you enjoyed this presentation. And if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Once again, I have put this calculation in a table in case you find difficult to read my handwriting, or I have put a wrong number somewhere while writing the answer. So I have put it over here for your final reference as well. Thank you so much and happy learning.